and I'm finally giving some updates around some of the market and more so around the question of should I be changing my investment strategy based on current market environments? Stay tuned. One of the biggest questions I've been getting from clients or from you guys more so recently in meetings is, should I be changing my investment strategy? Now, some of you have retired, so you're taking out distributions from your accounts, and those are in the final stages, coming close to retirement, right, are asking similar questions. Should I be changing my investments as I get ready to retire in the next 1 to 2 years? So in this video, I wanted to kind of review what that looks like and how we approach retirement investing in general. Now, one of the biggest pieces for retirement is that we are still planning for you to live a long and healthy retirement, meaning if you retire somewhere around 65, we don't want to get so conservative in our investments that if you live till age 100, you haven't had enough growth in your accounts. So even though there's a lot of headline risk today, especially with inflation, energy, and Russia, those are the three big themes coming out and weighing really heavily on markets, pushing stocks down, pushing bonds down, not as much, but not creating a nice environment for us to pick off some gains and continue distributions in retirement. So the first thing that we have to look for is, where are we going to find growth? And I said this as much in my email around last week around inflation, right? If you take a look at the landscape of where can you invest to get some growth in your assets, get some interest dividends, right? There's not a lot of options. Now you have to essentially stick in stocks, because even if you want to go out and invest in some property, it's not like that's creating a sustainable cash flow. I mean, at one point it can, but that's going to cost you a lot. It's going to use up a lot of your liquidity, and it's not going to give you a lot of options down the road. So one of the big areas we look to is obviously the stock market. And even though prices and stock market has come down so far year to date, we still believe this is the most viable option going forward. And if you take the example of putting money aside, just setting aside in the bank, yes, the Fed will raise interest rates here at some point, and savings rates will come up. Maybe they're around 1% in like a high interest savings, or at 2%, in a high interest savings. That's still not going to outpace inflation. And I brought that up in my letter or my email, that even if you're socking money away in the bank, counting on it to be safe, well, you're still losing to inflation, right? Because inflation is still running hot at 7 to 7.5%. So when you're going out, filling your tank up with gas, or just buying groceries and doing your daily activities, you're seeing the pinch there, because inflation has been driving those prices so high. And in some cases higher than 7.5%, right? Energy especially has gone up a lot more than that. So what can you do, right? We have to at least stay invested for growth at some level. Otherwise, what we're going to end up doing is socking all our money away into cash, setting it aside in savings, and just sit on our hands until things turn around. Well, that creates this scenario where we're just trying to time the market. So again, think back that, number one, we need growth in the portfolio for retirement. And given where things sit today in the market environment, where are we going to turn to? So if you're already invested, we're not going to make a lot of big changes around the investment strategy. And the reason for that is, where are you going to go? Again, you're going to flee to bonds and maybe try and get into some cash, but you're still going to get beat up from inflation. And when the stock market eventually turns around, you're essentially out of the market in that case, right? You haven't stayed invested. And so as everything starts to rebound, you're trying to time it and get back in, and you might end up buying, at a higher high than where you had left the market. So that creates a real challenging scenario for you, especially in retirement. And that creates the challenging environment because we have to create a consistent cash flow, right? So even in times where stock market is down, like we've seen in the last couple months now, we still want to have this strategy in mind where we can create distributions. Now, especially as you're not working and you are retired and you're counting on this stream of income to sustain your lifestyle, What do we end up doing as the investment and financial advisors? Well, first and foremost, we want to make sure that we stay diversified. So we want to have a nice balance of some aggressive stuff and some not aggressive stuff. Because in times like these, where the aggressive stuff is really hitting the portfolios hard and bringing down our portfolio values, we want to make sure that we still have almost like a safety net. And that safety net to us comes through investments in bonds, right? The other term is fixed income. So by having some of those things set up, when the stock market is down, most of those investments are going to be hit a lot less than stocks. And so that creates the environment where we can start to pick off some of those fixed incomes or bonds, mainly TIPS. TIPS are Treasury inflation protected securities. They're a security that's supposed to be tracking inflation. So it's a very short term. Every couple of months, it kind of turns over. So we're utilizing those assets to create your income stream. And to us, as things rebound and recover, at some point here, then we go in and we rebalance. So we essentially say, okay, well, certain areas of your portfolio have underperformed or they're not performing, so we're going to make sure the balance is correct. So then as things kind of swing up, we're hoping to have some what we call some overweights or some more allocation into that specific piece of your portfolio so that we can get some more of that growth. And then as the growth comes, then we make sure we don't get so aggressive that we don't have a lot more of our safety stuff or a lot less risky type investment like the bonds. So then in the future, we've built up this stockpile, or sometimes I'll call it the war chest, so that if things continue to deteriorate, then we still have this war chest of money that we can create distributions for you for retirement. So I want you to consider that as part of the strategy that we're working through, that's what we're constantly monitoring, right? And there's also some investment strategy behind that as to where we see some value and opportunity. Maybe it's energy, especially right now. And so we're doing more of that in the background. However, the big picture and the overarching goal is that we want to ensure that you're going to have cash for your retirement. And so as things progress, we want to stay invested in even some of the aggressive stuff that has been down. I would say the hardest part, though, is being in this retirement phase, right? So a number of you have told me, hey, yeah, Nick, but it's different as I'm retired because, right, I'm not out there earning an income. I can't continue to work and delay my retirement even though things are rough. Well, part of what we go through on the planning process is we plan for those exact scenarios, right? We plan for some bad timing. We also account for there's going to be certain years where the portfolios are down, right? And so as part of the background planning and analyzing that we're doing, we're ensuring that we're thinking of all those things because we know they'll end up happening at some point. We don't know the timing of them, but we know the portfolios will take a hit at some point. And typically the worst time to take those hits is right when you are retiring. So if you've managed through it so far, then things can obviously progress in a positive way. It's just continually sticking to the strategy. Because if we flock and flee to cash, then that creates a really hard scenario for the future. It can feel safe and emotionally okay right now, but it doesn't create a nice long-term effect down the road because we don't know when you're going to get back in or what the timing's going to look like. And if things have recovered, then you've missed out, right? And that's part of the analysis is even though as things come down, we want to make sure that we stay invested because we know eventually they'll come back around as history has shown. So don't get caught up in, hey, it's different because I'm retired, or it's different because I'm drawing down my income right now and I can't go out and earn some income. Well, we know that was always part of the strategy. And so for us, our big ask would be, make sure that you're talking to us about this because this is what we have in our heads in the background, if we haven't said it as much, that we have portion of your portfolio, the war chest, to be able to create distributions for you going forward. And if there comes a certain point where the portfolios just get rocked so hard, we may reach out to you and say, hey, it's time to reduce your distribution by 10%, like I talked about in a couple of my last videos. And then as the portfolio recovers, we call you again and say, okay, hey, you can, basically ramp your distribution back up to what you had it. And so doing little pay cuts or pay increases is still dependent on the market, but the variation you have is 20% from year to year. So that's a big swing. So specifically to those who are looking to retire in the next couple of years, right? It's still the same idea as those retired. We don't want to create an environment where we're getting so conservative that you're not going to get the growth that we need you to get for the future. Because again, if we were planning for you to be around for 5 to 10 years, maybe that sways our investment selection or our investment strategy. But if we're talking retiring at 65, there's no reason for us to be so conservative that we're going to generate this small return for another 30, possibly 30 years, 40 years, right? And although some people may cringe at the idea of living that long, right, that could be a possibility given the current state of how long the average person lives in the U.S. So it's not something that we want to avoid doing, or it is something we want to avoid doing, is shifting our investment strategy as we get closer to retirement. We want to make sure that we know the distribution amounts. We want to make sure that we know we have some kind of war chest when things go wrong and plan accordingly. So that doesn't mean run to the hills and put everything in cash or try and be so conservative that we don't get any return. We just want to be cognizant of the fact that the market will continue to do this, right? This is not going to be the last time that the market is down. It may still have yet to go down, right? It still may have room to continue to slide. We just don't know, right? And that's what makes investing really hard, is the emotional struggle behind, well, I can try and time it. I can get out because I feel like everything's going to go down. And then the very next day, the market can jump and you've missed out, right? It can continue to go up. So if you're feeling anxious, if you're feeling like that's you, let us know. Give us a call, email. We want to make sure that we're having these conversations with you because, the headlines can create this anxiety around, hey, am I going to be okay? And when we're looking at things, especially in our meetings, that's what we're verifying. And that's what we've accounted for, either before you retired or as you're approaching retirement, to make sure that we're thinking of these types of scenarios, because we know this is not the last one by any means, and we know this will happen again. So that's our strategy. And we are looking to take some opportunities in some of the energy space going forward. But in terms of the overall strategy, no, we don't recommend you shift away from what you currently have invested. And we still think that equities and stocks in the long run provide, one of the best ways to sustain your lifestyle in retirement, even combating inflation, and for all those reasons that I mentioned in my email. So if you got questions, comments, concerns, please let us know. If you liked the video, give it a thumbs up on YouTube. It really helps me grow the channel, and please share with your friends. And as always, please enjoy the rest of your week and have a great weekend. Take care.